This is part 3, trading indicators. Crypto trading indicators are tools used by traders to analyze the market trends, make more informed trading decisions, so it's less like gambling. Here are some popular crypto trading indicators. Moving averages, relative strength index, RSI. That's a popular one that I personally like to use. Whenever things are overbought, it can show you that it's possible that it's coming down, and when things are oversold, it can show you that there might be a buying opportunity there, meaning that it will go in the opposite direction soon. We're not going to get into all of these and stuff, but if you want to try them, you can go ahead and try them. There's definitely a lot of videos out there on how to add them to your whatever chart that you're using and to follow them and how to understand and read them. Okay, so just know that no single indicator provides that complete picture. For some people it does, but I know that it doesn't, because if that was true, then everybody would win. Everybody would be millionaires or billionaires, whatever. Crypto taxation, regulations. A lot of stuff is happening. I don't even really want to speak on this too much because of so much stuff is going on with the SEC and what they're doing. And yeah, just cryptocurrencies are treated as property for tax purposes. So that means just like if you sell this, you're going to be subject to capital gains tax. Less than a year, 30%. Over a year, depends on how much you made, how much your income is, things like that. But the IRS does have guidance on how to treat those types of things. Like I said, a lot of cryptocurrency exchanges have KYC now, and the regulations are growing quickly, as we can see with the whole SEC versus Grayscale and their spot BTC thing that they got going on. So yeah, we'll keep updated on that on this channel. It's important to keep accurate records of your cryptocurrency transactions for tax purposes, but that's mostly what these tax applications do. Like I said, I used Coin Tracker. There's plenty more out there, and they just give you the date of the transaction, amount involved, and most of the exchanges, well, Coinbase does give you that, and crypto.com gives you that. So they'll give you a list that's based on all your transactions and things like that you can download or plug into the application, anything like that. If the exchange is not having KYC, I'm not sure if they would even keep track of those records, so I don't know if they have them or not. They might do it, but they just might not report. I don't know, because I don't use them. I want to pay my taxes. It ain't worth it. Dealing with corrections. Obviously right now we are in a crazy correction period where the market is extremely low. A lot of altcoins are down over 90%, and Bitcoin is clearly not at 70k or 69,000, whatever it went to. Don't overextend yourself. Don't put more than what you are willing to lose, but this also goes into knowing what you're doing as well, because if you know that something is could be a financial benefit to you, then you might want to go ahead and do it. It might just be you just being nervous, things like that. But if you know what's going on and you can see that, then it might be a risk that you're willing to take. Of course, it goes with risk management and how much you're willing to put on the line for it. You could seek professional advice, of course. Keep a long-term perspective. This is very important, but if you're a trader, then I guess it doesn't really matter, because you're just looking for that quick buck anyways. However, in my opinion, it's better to keep a long-term perspective. Don't panic sell if you're holding for the long term. If you know exactly what's going on, then obviously you know it's time to sell and you're not panic selling. But if you're just panic selling, markets go in cycles, so just continue. If you're right now and you hold through these last 2 years, then you might as well just continue to hold. Consider buying the dip. Like I said, red days, things like that. Diversify your portfolio. If you're in a lot of different cryptocurrencies versus just one or two or three, if one goes out and you're in three, I mean, you come look, that's 33% of your portfolio that's out the window. And you only have 66.7, whatever. Yeah, no, we're not doing that. Okay, so keep diversified. If you have like 20 different things and one goes out, that's not even going to affect you as much, especially with the gains that you should have been getting on those other 19. Keep up with the market news. This can fluctuate the markets. Even in the stock market, the S&P 500 and all that stuff affects Bitcoin as well, because it's the same people that are investing in these types of things. And consider using a stop loss order if you are in, trades, things like that. When it hits a certain price, then you can limit your losses. Goes with risk management. Let's see where we're at on time. Tokenomics. Trading volume is how much money is being sold and bought in the market. So whenever you look down on a coin and you see volume, that's what that is. How much is going in and out of that coin. Circulating supply is the number of coins or tokens that have been created, and it's the percentage of the max supply. The max supply is how much will ever be out. Circulating supply is how many coins are out now. Market cap is how much money is within the project. The price times circulating supply. All right. So you multiply the price and how many coins are out, and you will get market cap. And the burns, permanently removing tokens or coins out of circulation. Different projects tend to do this over time, or they would just slow the amount that comes out, like Bitcoin slows the amount. And this is why diversity matters. Of course, I kind of already explained that, but diversification is nothing new in the world of investing. It just means using adequate risk management. It avoids extreme portfolio losses from being overexposed onto a certain asset. I've been in this position, still am overexposed to crypto.com. And just be plain and simple about that. A balanced portfolio means that you can get gains over time from many different assets. Keep your emotions out. This is more of a just keep your emotions out. These are things that I work on more of a fixed type of system. So just be less reactive when it comes to certain things. Now, of course, you're going to feel what it feels like to lose money and to gain money and things like that, and it's just going to take some time. It depends on how you are as a person. It's going to take some time to keep your emotions out, but keep it in the back of your head. Keep your emotions out. Be more on like a fixed system type of thing, or like robotic, I guess. Keeps you actively researching when you are diversifying. Keeps you actively in the space, knowing exactly what's going on. That's very important, because if you see like a certain project that's being talked about as doing bad and you're in a great position in that project, maybe you want to get out, because maybe that could mean that this project is going to have a rumor and it goes down, and maybe it is just a rumor and it's going to go back up. Now you can buy it back more in a lower position. Now, this isn't necessarily trading, but this is buying for the long term and keeping your portfolio just, keeping your I's dotted, your T's crossed. Swapping combines the actions of decentralized exchange and centralized exchange by exchanging one cryptocurrency for another. So if I take Bitcoin and I want some Ethereum, I can take that Bitcoin and trade it for Ethereum. This is technically a taxable event because you're selling and buying, but it just limits like the whole process of selling my Bitcoin and then taking my US dollars and then going and buying that. It just does it automatically. Trading is when you use it to sell your crypto for fiat and then back to crypto. You're doing this back and forth type of thing. That's a taxable event as well. Can incur a lot of fees depending on which exchange you're using and the methods that you're using as well. Maybe it doesn't matter if you're using leverage, then those trading fees don't even matter. Action of trading and swapping have a very little difference. Using a centralized exchange will allow you to better track your activity for tax purposes. There's still other ways through other applications. You just connect your wallets and things like that. Like I said, everything is public, so they'll be able to see everything. So just go ahead and do what you gotta do. All right, I think I will save this for part 4. I think we're at now. All right, catch you in part 4.